making dreams grow. First-time buyers stepping through the door. Keys to the castle, they're what we're here for. Navigating through the home buyer's maze. Educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new lair. Navigating through the home buyer's maze. Educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new lair. Jeb and Josh, they're paving the way. Dreams to reality, they make it day. From the first hello to the closing sign, your journey to home is looking divine. The numbers make sense. Jeb shows the vision beyond the white fence. Teamwork like this is rare to find, helping you leave all your doubts behind. They talk about homes and talk about life, cutting through the stress and the buyer's strife. With every word they light up the spark, guiding you through when the road feels dark. Jeb and Josh, they're paving the way. Dreams to reality, they make it day. From the first hello to the closing sign, your journey to home is looking divine.
Happy end of July. Welcome to another week of the Educated Homebuyer Live. Mr. Josh Lewis and myself here to educate you in the real estate world, mortgage world, and ultimately help you become the educated homebuyer. Mr. Josh, Fed Wednesday, a lot of data coming out this week. How are we doing so far?
This has been a super data heavy week. And probably the most important statistic of the week, Jeb, is we are 58.33% through with 2025.
Wow. Did you just do that calculation right now? Did you ask GPT?
7/12.
There you go. I like it. But we're not, because we still have a day tomorrow. So,
one day. So maybe it's like 58.30. I was probably a little
off.
off.
You're slightly off, but it's all good. So crazy to think that we've been doing this for 7 months this year, but we've been here for 4+ years, guys, educating you guys, helping guide you through the process. So with that, we've helped hundreds of people here on YouTube. If we can help you, there's a link in the description of the video. Always reach out, happy to do that. Always have people we're helping. And a lot of you guys are listening. So all that's good stuff. So we typically start the show by going over some charts, what's happening in the economy, data wise, what's impacting inventory, mortgage rates, all of that good stuff. We're going to talk about the Fed, the latest move or lack thereof. But while we're doing that, let us know in the comments, what do we want to know tonight, Josh? We know where they're from. A lot of these guys are from. Like what's an interesting stat that we can ask?
Ooh, we already went through fast food. That's the favorite fast food. And if we ask pizza's local. That's like good stuff.
You can't go pizza. What's your favorite social media channel that's not housing related? Let us know. It could be any platform. Let us know. I like to see what people are in tune with. My wife watches entirely different stuff than I watch.
Yes, 100%. You like the people that are on TikTok. The guys I used to play basketball with 30 years ago. We have a text thread, and one of the guys is always sending TikTok links, and I'm like, I don't support China. And then one sending Instagram links, and then the old man in the group is sending Facebook links. No one looks at Facebook anymore, so it's
actually I got a better one. Let's not even go. What's your favorite Netflix show right now? That's what I want to know. Give me your favorite Netflix show. There's some good ones. Like we're in deep on a couple of these, so there's
I haven't been excited about anything. I've not been excited about anything on Netflix since Squid Games, the original Squid Games.
Squid Games, Jesus,
yeah, that was the best one.
All right, here we go. So we're gonna dive into some charts. We've been wasting enough time already, so let's take a look at the charts as we always do. We don't even have them in there, Josh. There they are.
We forgot to share them.
Forgot to put.
Didn't even prep them.
So the big news this week is really that there's no news. 856,000 homes to 860. So inventory is up slightly. We only have 27% more inventory right now than we did last year. As we've talked about before, there were times in the year where we had 30+% of inventory, 33% at times. Now we're down to 27%. It's probably going to continue to contract throughout the remainder of the year. It's going to get less and less, even if we get a little bit more inventory. It's just not going to have the volume there because of the contraction that typically happens in the second half of the year. Now, Orange County, Huntington Beach, Orange County down slightly, just 0.46% to 4,999 homes. So just under 5,000. Huntington Beach up a smidge, 1.7% to 294 properties. Really nothing really to report here on either front. These are low numbers. The bar is low. Not really much to talk about here. When we talk about new listings and pending sales and all of this stuff that we typically talk about, I'm not going to talk about it this week because it's boring. It looks exactly like it has for the last however many months. You still have small increases, still up year over year. But there's not really a lot going on there. I'll continue to put the charts in. If you'd like to go back through them, you can take a look at them, but we will continue to report on it. But when there's actually measurable data that means something, I'll stop and I'll tell you what's going on. Until then, I think we're just going to continue to press forward. But something, Josh, you and I talk about is real home prices. So the title of tonight's show is asking the question of where are home prices headed? At the moment, I think we're in real terms about 2% below where we were the peak in May of 2022, somewhere in that ballpark. So we're down slightly. But one of the things we talk about, Josh, is affordability. A lot of people out there, we don't care about prices. We need rates to come down or vice versa. We don't care about rates. We need prices to come down so affordability improves. The reality is affordability is improving, just not at the pace that people want to see.
Yeah, when you look at this chart, the interesting thing to me, the anomaly here is when it peaked in 2022 and we had a nice quick correction in real home prices, and largely because it wasn't that home prices dropped a ton, Jeb, inflation was really high at that point in time. So home prices went flat to slightly down for 2, 3, 4 months, and inflation was still really high. But what this chart is telling us, that little green box over there, is that in real terms, so home prices are going up less than inflation since that time frame in 2022. And I expect this to continue. I don't know about yourself, Jeb. We may get out and out nominal home price gains, but I don't think we're going to see real home price gains, even if inflation gets down to 2%. I don't think we're going to get a below 2% anytime soon. And we could easily see several years of 0 to 2% home price growth. So Bill McBride covers this. He shows monthly and nationally. They move very, very similarly. Another thing here we talk about really big on the show, one of the benefits of being a homeowner is it protects you from rent increases. So rents have been moderating. We got apartment list numbers came out today, and they were up 0.8% year over year. So below the rate of inflation, also flat or negative in real terms. But price to rent, you see, has come down pretty strongly in 2022 because home prices are not going up as quickly as rent, even though rent has moderated. So the last one he threw out here in this same article he put in is the Housing Affordability Index. This simply takes into account the three things that we talked about: home prices, wages, and interest rates. So we've talked about it. We talked about it here on the show for 2 or 3 years. We have not seen any of the movement that we want. Home prices haven't dropped appreciably. They've increased minimally. Interest rates have moderated from the worst levels, but they're still toward the high end of that range. The only thing that we're seeing here in terms of improvement in that affordability is wages have gone up while the other two haven't worsened. So this is a chart, Jeb, we probably should revisit just once a month and see what this does over time. Because you go back to 2022, we're pretty much sideways in terms of affordability. Since the worst part when rates peaked at their highest level, we're definitely improved, but still near the worst levels of all time, other than back here in 1982 when you had 18% interest rates and affordability was terrible. So something worth noting and worth looking at and giving yourself context. When you're watching numbers online, most likely at home, you look and go, oh, interest rates are still really high. Home prices are really high. Over time, things are improving because inflation eats away at those numbers and wage increases help. This one here, I'm super careful with any data from Mr. Wolf here because he is basically a perma bear looking for a story to sell you about the imminent crash. But this, what I think is important or valuable about this chart, the little box in blue, negative real mortgage rates. What does that mean? We're talking about real numbers here. So from 2021 through late 2023, we basically had mortgage rates that were less than the rate of inflation. So 30-year fixed rate minus CPI inflation was negative. So when you look at that, what we're saying is people were incentivized to borrow. So it's not
Sure.
any mystery that we had a lot of home sales and we had a lot of loans and big loans done in that time. So it pulled forward demand. So in addition to the affordability constraints, it makes sense that we would have really low volume right now. He has this blue band in here saying that real rates, normal is, 3.2 to 4.5. I'll do a little bit more research on this. I think it's reasonable to believe if you look from the left of that chart to the right, even if you take out the period of QE post GFC, you're looking at a downward slope. So I still think it's reasonable that rates would trend lower, but we should all hope that we never see another period of negative real interest rates. So Jeb, the important news of the day. I wanted to start with the 10-year chart. Not that this is important, but this shows you what was happening. This is a 5-minute chart of bonds today. And the 10-year yield was coming down nicely until the Fed announcement kind of went sideways. And then the Q&A is where things really went sideways. And this is all, we're going to put this in context. We're a 4 basis point improvement or worsening from 434 to 438 at the worst levels of the day. And we closed just under 438. But the press conference, the Q&A was definitely more important than the announcement of no action. One of the things, Jeb, that people may be seeing tomorrow or seeing on the news tonight, we had 2 dissenters. CNBC was reporting this as the first time since 1993. Matt Graham was kind enough to report that is not true. Multiple times where we've had 2 dissenters. A couple of other folks that I like to follow, Peter Bookvar pointed out that Waller and Bowman better be dissenting today because they both have been out for the better part of the last month saying that they are in favor of rate cuts, and they both would like Mr. Trump to position them possibly as the next Fed president. So doesn't really make any difference. We always like to point out what changed in the announcement. If you read through this, not much. Although swings in net exports continue to change from have affected to continue to affect. Indicators suggest that growth of economic activity has moderated has continued to expand at a solid pace. And then uncertainty about the economic outlook remains elevated versus has diminished but remains elevated. So really no change there. So you may be asking, why were yields 4 basis points worse at the end of the day than where we started, despite the Fed doing nothing? And it was all in the press conference. The markets were hoping that we were going to get a dovish Powell, and we didn't really get that. Didn't get a super hawkish Powell, but I'd like to go through his main quotes here. Still early days on inflation impact of tariffs. Tariffs starting to show in consumer prices. Expect to see more impacts in inflation data. Could say Fed looking through inflation by not hiking. People are talking about hiking. We're looking through inflation by not hiking. So they don't think it's going to be that bad, or they would be considering hiking. It's not even on the table. Economy calls for modestly restrictive stance for now. Depending on whose numbers, we're at least modestly restrictive without any coming cuts. Can't separate out tariff effects on inflation. Services inflation coming down nicely. Goods going up. Some companies will take advantage of tariffs. What we see now is the very beginnings of tariff inflation. So really inflation. On that topic, this is a chart from Statista. We're going on 4 years in a row that this has been the #1 ranking issue when consumers in the U.S. are polled. It is important to note that in 2022, this was a major issue. 2023, it was slightly improving. The last couple of years, inflation is not the issue. Inflation is the rate of change. Prices are the issue. So I don't know how they frame this or ask this, but prices are the issue, not inflation at this point. Along those lines, we like to look here. He's talking a lot about inflation. Truflation says basically flat over the last week, 2.02, 2.04, basically where the Fed would like to see it. Tomorrow, Jeb, we get a really important report. PCE. Today, there's a subcomponent of the GDP numbers that includes PCE. These figures here were updated by the Cleveland Fed, so I'm going to bet these are really close to accurate. Core PCE, they're predicting to come in at 2.66. They round, so that will get reported as 2.7. And as you can see, last month, we were exactly at 2.7. So not much of a chance for a change there. So we shouldn't see improvement for better or worse. I guess you couldn't have improvement for the worse, could you, Jeb? So
it's an oxymoron.
Someone's a moron. Let's just say that. So
Maybe yes.
we got ADP figures today. You'll all remember the cute little vanilla colored line there. We had a big negative ADP job report that was revised up, but still negative. And we had an improvement here this month in those numbers, but it's still very negative. And I actually had the numbers here. I wanted to tell you guys. So 104,000 jobs, 28,000 more than was expected. And then June was revised up 10,000, but still 23,000 jobs. Here's the important part. You can't see this in this chart. The 3-month average is 37,000 new jobs per ADP. The 6-month average was 67,000, and the 12-month average was 130. So you can see that descending green line. We are absolutely seeing a deceleration in employment, even though we're not seeing a big uptick in the big negative numbers. So the Atlanta Fed GDP now, GDP was announced today, so everything's incorporated. You see that big spike basically got reported there as 3% GDP growth. But what we're going to see is it's a little bit smoke and mirrors. Last quarter, Q1 was at negative 0.5, and we are now at 3 for Q2. So that first quarter, if you remember, it was thrown off by front running the tariffs and a lot of imports at that time. And now we had many less imports this last quarter, and it's spiking the number. So really, when we look at those, here's the actual formula for GDP. So that last piece, the X minus M is exports minus imports. So we had a ton of imports in the first quarter. They were much stronger. And this last quarter, we don't have those imports. So when we look at that, and you can see graphically here, these are all the components and how they contribute to GDP. Imports were heavily negative there. So when we average that out, we're really looking at 1.25. Very anemic growth. So the headline looks big. If you look here, again, contributions, consumer spending was up, but healthcare was the biggest contributor to consumer spending. Pharmaceutical products, biggest contributor to non-durable goods. So when we look at these things, it was really a change in imports and strength in consumer spending based off of healthcare and pharmaceuticals continuing to be expensive. So where do we go from there, Jeb? We are now at a 54% chance of September giving us no change in Fed funds. And if we look out through the rest of the year, we are now looking at a 62% probability of just one cut through the rest of the year. It's important to remember we have almost 2 months before the next Fed meeting. It's at least 6, if not 7 weeks. There's a lot of data to come out, 2 PCEs, 2 CPIs, 2 jobs reports. So we're going to have a lot of data. This can change, not saying it will, but it certainly can. In the big picture, you see that green candle today. That's where we're saying the 10-year was up 4 basis points. It was down 7 or 8 yesterday. So over the course of the last week, we really haven't gone anywhere. A lot of day-to-day movement. You see the headlines, people have to make something out of nothing in terms of, hey, this is what happened. And is there accuracy, is there truth to that? Yeah, this is what happened, but we're really in a sideways consolidating market, waiting for something to break in terms of inflation moving much lower or employment getting much worse. You see the same thing here in the data from Mortgage News Daily, flat all the way around, 6 3/4 on conventional, 6 3/8 on FHA, VA. The other loan product types we'll get in where they fit in. But that's all we got for this week, Jeb.
Good stuff. Good stuff. All right. So do us a favor. If you have questions about any of the information there, you can reach out using that link in the description of the video. Need to get pre-approved, go through that process. Get referred to a real estate agent. That link will also get you in touch with us. There was a question here, Josh, from Sam. Just says, great content and discussion. Is there a link to the places where y'all resource the data you are presenting in the stream? And the answer is no, unfortunately. The data comes from a lot of different places. Newsletters that we subscribe to. Some of it comes from different people on X and just different places. So we're just aggregating it from a bunch of different places. Something we have discussed is potentially doing a weekly newsletter, where we can maybe put some of this stuff into a format and actually send it out so you can have, the information with some context outlined. But it's gotten no further than an actual discussion. So
because it's a lot of work.
Because it is a lot of work. But there might be a time and place for it. But at the moment, that's where we are. One thing I have noticed is that Willing seems to be taking up the entire chat with just insane comments as normal, while everybody else is just sitting back. We've got Blind Spot is an option on Netflix. House of Ninjas.
Is it just
That's our only two
a
options?
bunch of ninjas that attack each other in a house? Like you put them in a
Yeah.
Big Brother house, and all of the ninjas see who can sneak up on the other one.
Yeah, no one is giving me anything that I feel like is I'm not gonna say worthy of watching, but when I read those titles, Blind Spot intrigues me more than House of Ninjas. But I don't know. I don't know what to expect with House of Ninjas, Josh.
Jeb. So well,
Yes.
let's just go. We're gonna go down Sam's path. I'm not going to dox him this time. We'll just call him Platinum Black. You got mad at me for using his real name, but time to start a Substack. Really, that is the best format for stuff like this. If we were to do it, that is probably exactly what we would do. And some of these are from paid Substacks, so you got to be careful. I mean, most of it is different people's analysis of free data that is out there, but we have the data sources. It's a lot of work to compile them, put them in one place, and give you guys all the commentary. And it probably would end up being free because people are fed up with paying for $5 for 87 different Substacks.
Yeah, and we started a school at one point, and now school's price just came down. Now it's $9 to have a school instead of 99, Josh. So maybe we should bring that back. I don't know. It's just a lot of work, and there's only two of us, and we're trying to sell houses and
Do
do
loans.
mortgages and create content, and this is just crazy. But we got a question here from Red Apples. Kim, do you think that Powell will be gone in May, or will DT remove him? I think the probability
they're friends. Last week he
Yeah.
said he's a good guy. They're friends now.
I saw a video of them online
Kung Fu fighting?
so I don't know. No, I think Powell probably stays. I think it would be more difficult for Trump to actually get him out than is actually reported. And by the time it happens, we're probably there anyway. I mean, you got to think we're not that far off at this point. What, 10 months from that actually taking place? So I think he probably stays. I think he's there for the long haul. And even then, let's be honest, if something happens, I mean, I talked about this on a video this week. If he removes him or somebody comes in and starts rate cutting, it's not, I think it's going to have the opposite impact on interest rates than most people would want to see, because of the uncertainty, because of, people now viewing the US as this, political deal with regard to Fed versus them being, a separate, party and not have any influence. I think the credibility goes out the window, and it creates more volatility, at least on the long end of the curve. Short end of the curve probably corrects.
Well, well, that's the thing. What would happen if he could snap his fingers and replace him with one of his preferred minions in there, and you start getting rate cuts? What's it going to do? The short end of the curve is going to improve, but you would see worsening at the long end of the curve. Every time he's threatened Powell, that's the quick move that you've seen in the futures markets and long-term, like 10-year, 30-year treasuries. And the reason is, like Jeb said, you lose independence, you lose credibility, and the fear is that cutting too much too soon will lead to future inflation.
There you go. All right, let's see. We got a question from the realist 714, probably Orange County. I talked to a mortgage officer at a bank. Did I click on it? You did. Who said that they have a 12-month reserve requirement. Josh, is this something that is bank to bank? Is this a Fannie Freddie guideline? Does FHA have this? Like, what is the requirement in general for reserves?
1,000% not standard. So when you say bank mortgage officer, if they're a true portfolio lender, they can set their guidelines wherever they want. And if they want guidelines that stringent where someone has 12 months of post-closing reserves, they better be offering you something fantastic in return, like a much lower than market interest rate. If not, there are a million different programs. Fannie Freddie do not require that. FHA, VA, USDA don't have any reserve requirements. Sometimes for weaker borrowers, the difference between getting an automated approval and not getting an approval is having those additional reserves. I don't think that's what we're talking about. I think they're just saying our guideline is we want 12 months of post-closing reserves. Even most jumbo loans, I say most, probably 75, 80% of jumbo loans are what's called an AUS jumbo. AUS stands for Automated Underwriting System. You guys have heard of Fannie Mae's DU, Freddie Mac's Loan Prospector. So almost all of the jumbo programs will require the loan to be underwritten through DU, and it will come back and it will say approve, ineligible. It's ineligible just because it's higher loan amount than Fannie Mae will buy, but it's meeting all of their underwriting requirements. Most of the time, they're following the Fannie requirements. Some of them will have 2 months, maybe 6 months. Unless you're looking for a $3, $4, $5 million loan, you should not be needing 12 months reserves. For some portfolio lenders with really big loans, you can absolutely get into 9, 12, 24 months. But unless you're getting a smoking deal from a portfolio lender, or you're asking for a ton of money, you shouldn't have to have that amount of reserves. So give us a call.
There you go. Link scrolling there at the bottom. Let's talk about how Willing's about to get kicked out of here. Says, get me a derma roller so that it will help my receding hairline and my shrinking crown, I'm assuming is what he's saying. Basically, like what he's telling me is I have a receding hairline, Josh. I do not have a receding hairline. I do have some thinning hair on top, but it's pretty good. It's not too bad.
You and I are blessed in the hair
derma roller,
department. We got
like,
lots
what are
of
we
hair.
talking about?
We got lots of
Wolf,
hair.
I Willing, I expect an apology, or otherwise, like you might get demoted.
Yeah,
even
might
further
be out of here.
Even
I
further
thought you were just going to kick him out for 9,000 comments out of 9,005.
No. Like receding hairline, like that's threatening the only thing I have, Josh, is hair. Like that's, Joe does mortgages. It comes in with the question, says, what are your thoughts on the CFPB and trying to revise the LO comp rules yet again? Mr. Lewis, I honestly don't even know anything about this.
I've seen nothing on it. I get Scotsman, Housing Wire, Mortgage News Daily, Mortgage Professional. I've seen nothing on it. Very unlikely, just from the standpoint that it hasn't been a problem. They put some guidelines in place, and it's very, very hard for someone to take tremendous advantage of a borrower like it was pre TRID days. So I don't really see a reason for a change. It would be solving a problem that doesn't exist.
I did come across something last week where the California Department of Real Estate is now requiring escrow companies to, I don't think you can actually they can't pay a corporation unless that corporation is licensed by the Department of Real Estate. And so,
but did you, Jeff, did you see the guidance from the DRE?
I didn't.
It's insane. There's the DR, there's two, I think it's the DFI and the DRE both get to, because of its escrows and realtors, and like they're giving conflicting guidance. So someone's going to have to put their heads together and come out with some straight guidance. The DRE basically said, hey, status quo, do what you want. And the DFI is like, you can't do that.
Yeah, so I got an email from the escrow company that I typically use, and they're saying, hey, listen, we can't pay you unless your corporation is licensed under the company that you actually do business with. Otherwise, it has to be paid personal. So far, I've been paid the same way. So I assume I'm okay, but we will see. We will see.
Do you not have your corporation? You don't have a corporate DRE license? That's what you hang with Real?
I do have a corporate license with DRE, but I don't know that they have that. They have the corporation name. They don't have the actual corporate license. I don't remember what I did exactly.
Because a lot of people never, a lot of realtors have a corporation and they don't bother to ever get the corporation DRE license. It's not that big of a deal, but it's definitely an extra step, and a lot of people don't do it.
Well, you got to be a broker to do it, for one. You can't just.
See, I'm an uppity broker. I didn't even think about salespeople.
Yeah, there you go. Anyhow, we kind of got off topic there, but
back off topic. Mina says your hairline is fine. Both of us. She wouldn't know because I got my hat on most weeks, but
we both, we appreciate the support there. That's good. Josh, let's talk about American funding, new American funding. Is it better to use direct lender or a broker?
Let's define direct lender, because if you go to Chase Bank, if you go to the local credit union, they're direct lenders, but they're actual lenders. They're actually lending their own money. New American Funding is not a lender. New American Funding is what's called a mortgage bank. So they have a giant line of credit and they write a bunch of loans on that, and then they sell them into the secondary market. To varying degrees, to varying degrees, the vast majority of mortgage banks have a bloated management structure. And if you drive by a New American Funding office, they're pretty nice. So expensive real estate, lots of middle management.
Here, it just shut down.
Did they shut it again?
Yeah.
It's like the third time they shut the one in Huntington Beach.
That one's
Probably because
closed.
they couldn't afford that lovely office. So they have nice offices. They have lots of middle management. They generally have ugly rate sheets. I know some good loan officers that work there, some very good loan officers that work there. Would I say you're going to get a terrible deal or you should never go that direction? No, but if you want to talk to them, give us a call. Let's compare numbers and see what it looks like, because we can generally save you a chunk of money.
There you go. Good stuff. We've reached that point in the show where I want to ask a favor. If you find any value in our content, do us a favor, hit the thumbs up. If you haven't done so, depending on which channel you're on, there's a couple channels that happen here that all stream. But the Educated Homebuyer podcast, I think we're just over 7,300 or so subscribers on that channel. We're on Apple, we're on Spotify. A lot of you guys are listening and watching from there, and we appreciate that support. So continue to support the channel. Share it with somebody you know who's buying a home. We get a lot of positive feedback there. So we do appreciate all of that support. And so if you do so, if you find it helpful at all, make sure you hit that thumbs up and subscribe if you haven't. Subscribe. There you go. Not a lot of questions, Mr. Josh. We got a question about helping people in New York. We can't personally help in New York at the moment, but I can refer you to agents in that area. Josh, we have a great mutual contact that does loans in New York that can guide you through that process as well. So if you need help there, you can fill out the referral link, and we can still connect you with an expert there in that market.
New York is a pain in the butt. So the licensing, like you'll see a lot of places. Our buddy down the way that we've referenced a couple times, the company he works for, is licensed in 49 states. The one they are not licensed in is New York. New York makes things very, very difficult in terms of licensing.
There you go. That's how Vegas was for a while. Let's see. House of Ninjas is about a ninja family who, years after retiring from their formidable ninja lives, must return to shadowy missions for the government to counteract a string of looming threats. Did you type that up, or did you
Did
take
she
that
GPT
offline?
it? She might have GPT'd it.
That's a well-written explanation of what it is. And there's some words in there that I feel like I would have never used. Formidable, one of them. What was the other one in there? There was another one. Shadowy missions. I guess that's a place. Yeah, I'm feeling like you copy and pasted. Let me know if I'm right.
Jeb, I'm going to nominate this for the question of the day. This is the highest quality question we've received, and we've got 25 minutes. So we'll see if anyone can top this in terms of quality here. The realist back says, just like buyers shouldn't try and time the market, does this apply to sellers as well? Instead of delisting their homes because the market is shifting, should they just meet the market where it's at? A lot of the people that I talk to, Jeb, you've pointed out that 75% of sellers are buyers. A lot of the buyers I talk to are going to sell. And I hear things like, we're going to take it off the market. Oh, we took it off for 15 days and we're going to put it back on the market. So I don't know that the realist was actually talking about some of the games of on and off the market, but why don't you talk about all of it?
Yeah, it depends on the goal, right? If you need to sell and buy at essentially the same time, then you have to understand the market that you're in is the market you're in, right? It's going to be very hard to get top dollar for your home and then get some steal on a buy at the same time frame when you're doing things contingent. If you have an opportunity at the moment to sell, sit on the sidelines, and potentially buy something down the road, months, a year down the road, I think there's a possibility that you could get something, sell at what we're going to call like today's value and get something maybe a little bit less down the road. Is it going to be substantially less? Probably not. And by the time you paid the rent and where you're paying and moving twice and all of that, I don't know that it actually makes sense. So that's to be determined. But what I hear a lot of people at the moment when things aren't happening right now and they're thinking, well, I'm just going to wait until things improve and then I'm going to relist it. To be honest, I don't know that things are going to improve a lot on the listing front anytime soon. I think you're headed into a slower time in the market. I don't see a huge opportunity for rates to come down in a meaningful way. So buyer demand probably stays status quo. And I'm also a firm believer that if interest rates come down, low sixes, high fives, that yes, it does spur some buyer demand, but I also think it spurs some listings too. and it keeps prices from actually really going anywhere. So I don't know that there's this golden opportunity held by waiting to try to time the market on the selling side. I think when you're going through this process, there's typically a reason that you're thinking of selling, right? You don't just wake up one day and say, "Hey, I'm going to sell my house." There's something behind it. You're either buying something else or you're using that cash to do something, or there's some meaning. And so I think, what is the meaning? How important is that why and what you're trying to accomplish? And that's what you got to factor in trying to time the market just because things aren't, great now, thinking it's going to be better down the road. I think if you're waiting now, I think if you relist, you don't wait until, you don't come back on the market probably until like February, March of next year, right? There's no reason to take your home off now and come back in October. Like, unless something in the market changes entirely or your pricing strategy changes. My 2 cents.
It's just, I kind of feel like when we go back to that real home prices, I feel like we're going to be treading water sort of sideways in real home price terms. So like this expectation or hope that something's going to be different, or almost, I'll bet you a lot of these people are making the decision, Jeb, out of the fear that when we make the wrong decision, this is the wrong time, so I'm going to wait. So either hoping for a better time or just saying, oh, this is not the right time. I don't know. I just don't know that we're going to see a huge change in the next few years in what the market looks like.
Here's what I'll say. My neighborhood typically never has inventory on the market, especially certain floor plans. Like they sell very, very quickly. At the moment, we probably have, there's 450 homes in the neighborhood. So like when I say these numbers, these aren't large numbers by any means, but to have this many on the market, we haven't seen these numbers in forever, especially all active. There's probably 6 or 7 listings at the moment that are all active in the market. So if you said, "Hey, Jeff, I'm just going to pull my house off the market now because there's 5 others like me, and I'm going to come back on the market," you're probably going to end up regretting that decision, because my guess is some of these people probably have to sell for one reason or another, and their value is going to reflect, or what they sell at is going to kind of be the new comp. Not exactly, but it's going to have a basis in whatever the next few sell for. So if you have a property that stands out that compared to others in the environment or others in the market, then I think, hey, why try now later? If you're exactly like everything else and nobody's getting attention and you're just tired of it, then I can see waiting, but I don't know that means better by any means. So just thoughts. All right. Joyce came back and says she took most of the verbiage from Google. So it's basically about a ninja family who retired from taking on government ninja missions years ago.
I like her summary better than the Google summary.
Yeah, like that's where we're at. I still can't say I'm not really a ninja. I'm a sci-fi ninja person. Like those are 2 different genres entirely. But like, I know this is gonna sound crazy, like Marvel, all that stuff. It's not really my thing. Like I don't really watch those types of movies. I know they're great movies. I just not my thing.
Just watch Big Brother and call it a day. So hold on, Jeb. We missed a very important. Mina has once again contributed to the 805 fund that never gets spent.
The 805 fund in there. Oh, it does get spent, Josh. It just goes to places that aren't 805.
It just doesn't include the 805 aficionado. Geez. That's fine, whatever. So new home build charged $18,500 for a deck. Found my own deck company after purchase and paid $14,000. Just got a supplemental tax bill for $4,000. So she's saying it has a $4,500 difference. This is $4,000. So Mina, confirm, I believe you are in California. That would be the primary reason for having a supplemental tax bill. But she wants to know if your supplemental tax bill has
nothing to do with the deck.
So explain it, Jeb.
Yeah. So the supplemental tax bill was going to happen either way. And California, the reason this happens is because California, your property taxes, the basis is based off when you originally purchased that home. And so what happens is, say, for example, the previous owner of the property that you bought, hypothetically, let's say they paid $500,000 for that home. So the property taxes were based off $500,000. Well, when you closed on that property, let's again, just make up numbers, say you bought it for $1 million. There's a $500 variance there between what the previous owner paid for it and what you paid for it. And so that doesn't get, so when you pay your taxes through closing, you're still based off the original tax value, even though your impounds and everything else are the new taxes. So what happens is when the county records that and finally gets around to updating that tax information, they say, oh, Mina, She bought this house. It's now worth more than when she bought it. Oh, here's the difference in what the taxes were versus where they are. Here's a tax bill. And then you have to pay it. Now, once you pay the supplemental tax bill one time, or it's broken into 2 different payments most of the time, you'll never get another supplemental tax bill. Now, when you do improvements on your homes, a deck typically probably isn't one unless you got that approved through the city. If you went through the city, anytime you do permits through the city for additions, for improvements on the property, they'll tax you on those improvements, but it's minuscule. Like we're talking like dollars versus, thousands of dollars. So we're talking maybe $100-200 on like a decent size renovation versus, massive changes there, at least here locally.
So Jeb, we've got another question, and we can go in a different type of question. We give it a different answer. So Jay Homeboy, who has been absent for a few weeks, or at least not asking questions, who'll be better off down the line? 2 brothers, similar lives, similar salaries, married, 3 kids, similar house, $700,000. The difference is one pays off the house and has $500,000 in stocks. The other one has a $500,000 mortgage at 6% and $1 million in stocks. So instead of the $500,000 mortgage or paid off, they have a $500,000 mortgage and an additional $500,000 invested. So this is funny, coincidental timing here, Jeb. I have been reading, I believe it's called The Smart Path to Wealth. And it's a good book. It's a very simplified book, but one of his main points in there is people screw themselves by trying to think. He believes you should buy an index fund, keep it for 30 years, ride out the downturns, and you're going to be fine. And there is wisdom in that. So I'm going with this. So if you have the discipline to invest, to not sell when things dip, to not wait too long, get back in when things go, there is no question. And I actually, my custom GPT, Josh GPT, answered this. So in this specific example, no mortgage, 500,000 in stocks at 8%, so an 8% return. Going back the last 40 years, it's been over 11. It's like 11.5% if you reinvest dividends. But the future value of that 500,000 at 8%, in the end of the 30 years, he'd have $5 million. He'd have the home free and clear. So he has that $700,000 asset, whatever appreciation, and $5 million. So total net worth, $5.7 million. Home's actually probably going to double or triple in that time frame. But brother B, he would have a $3,000 a month mortgage. He'd pay about $580,000 over the life of that 6% mortgage. But he would invest that $1 million at 8% for 30 years. He'd have $10 million instead of $5. So 10 million minus the 579 that he paid in interest over that time, $9.5 million. You're gonna have $4.5 million more than the other brother. So it's an easy academic exercise. The thing that comes down to it is, are you that person? Can you put that money away, not touch it, and let it grow through the ebbs and flows? Because it's going to be a roller coaster ride for the next 30 years. There's going to be some awesome years.
I'm actually surprised by that answer. Like I didn't realize it was going to be that big of a difference. I really thought that brother A might have a chance in coming out on top with that scenario. But
the variable we would have to throw in, Jeb, is what if he takes the $3,000 and contributes that every month for the next 30 years?
Well, that's what I'm thinking. Like he's not gonna have, he's now got cash flow. So what's he doing with the cash? So he's got to be reinvesting that. But so if he's putting that in the market, then. But I guess we didn't throw that into the equation.
I'm throwing it in right now. We'll see what it comes back with.
Let's see. This is where GPTs are cool, like scenarios like this.
So Mina's in Maryland. A supplemental tax bill in Maryland. We will have to rely on the GPT to research that for us as well.
All right. What did we find?
So Jeb, it gets pretty darn close. Brother A, if he invested that savings, he would end up at $9.1 million. It's about a $400,000 difference between the two of them.
So brother B still ends up better.
Yeah.
There you go. There's your answer. All right. Let's see. We've got Smart Fox. Here's my plan. Prep the house to sell next year. After sell, go to vacation for 1 year trip around the world. Come back to buy 3rd year and keep my property tax. I'm 55 and over. What do you think?
So pretty sure, Jeff, he's got to be in California, right? He's talking about the 55 and over,
Sure.
Keeping his property taxes. Do you know the guideline? How long do you have to buy another property and keep your tax rate after you sell?
I think it's within 2 years is my thought. saying come back the third year. So I think that would still fall in the 2 years because he's talking about selling it next year. So I think it's 2 years to keep the 55, but you want to clarify and verify that just to be sure. I think it's fantastic. Like, listen, if you can afford at whatever age to go travel the world and feel confident that you can come back and have funds to live after you retired, shit, you've done something right. Like that's by all means, that's the thing. I think if I have any regrets, it's getting right into college. I mean, like getting right into a job right after college. I feel like if I was smart, I would have just gone and traveled the world, even with no money. You figure it out, like life lessons, you do some fun stuff, and then you start life versus just jumping right into it.
Your
But
parents are nicer than mine. My dad wasn't having that. After about 3
well,
months,
mine, I mean, I don't know that they had any. How did they don't have, how do they have a say?
well, who's footing the bill?
Well, that's what I'm saying. You figure it out. Like you just have to go get some jobs and do whatever.
I'm not a hobo. I don't cruise around the world. I've
Yeah, I
got
don't know.
standards. I
I
cruise
think
in
there's something to
style.
be said. And now, if you have money and you can travel, then you're doing things right. Yeah. So I like the plan. I like the plan.
Just don't
And-
be the retiree lady that sells her house with the plan to live on a cruise ship for the next 20 years, and then they cancel the cruise and don't refund the deposit. And they don't have anywhere to live.
That actually happened, I think.
Multiple
Something like
times.
that. Yeah.
Multiple times. Crazy people.
All right. Marcos, do you have any thoughts on bank statement loans? I'm self-employed and I have a 20% down payment and I have a 20% down. My rate 6.87, 6.85.
There's nothing wrong with a bank statement loan. There may not be any way around it if we don't have any other way of qualifying. If your tax return says you make $8 a year or lose $800,000 a year, the bank statement route is going to be the only route to go. So you may or may not have a choice. And what you're seeing here, my guess is you're paying a little for that interest rate. I mean, an 800 credit score at 20% down is going to get close to where the market rates are, but 6.85, that is absolutely not a 0-point interest rate. So the question just comes back, what are we doing? What are we paying to get that? And how are we going to structure it? And is anything likely to change in the future? Did the tax returns look bad for the last 2 years because there was a downturn in the business? Did you go on a cruise for 2 years? Or is that just how you run the business? Sometimes it's just the cost of business, cost of doing business. You save money by not paying taxes. You pay a little bit more on your mortgage.
Correct. Yeah. I'm sorry. I'm just reading some of the comments. Okay. Let's see. There was a question here, or a comment rather. It says, from Ray, says, I think prices will hit the roof as soon as the rate drops. So I'm assuming talking Fed funds rate. So last year we saw in September, the Fed cut 50 basis points. And all of a sudden, about a week or two later, that was kind of the bottom in rates. Rates from that point, we were close to 6% or so, 30-year fixed on a lot of, I mean, pretty close to it. Some transactions out there around 6% or so. FHA in the low fives, and interest rates just shot back up. Josh, what do you think happens as the Fed starts to lower the Fed funds rate?
I'm not even reading it as he's saying that he thinks when the Fed cuts. He's just saying when the rates drop. When the rates drop. So there's an assumption, there's a belief. Most of the people that I talk to
will hit the roof.
I say, what do you think is going to happen over the next 2 years with interest rates? I think.
Oh, you thinking it hit the roof like prices are going to go higher?
Prices will shoot up. Prices will shoot up.
I was taking that as prices are going to cap out. Like it's hitting the ceiling. But I get what you're saying now. I read it wrong.
And Ray, if we're reading it wrong, give us some context. But I think I don't think anyone can say that thought is wrong. I think if we go back and look at the chart of what's happened with affordability, so there's a couple of pieces here. We had the perfect storm in that we had a demographic wave of people entering the prime home buying age right when COVID hit. Then you had COVID lockdowns, a bunch of cash coming in, people being able to work remotely, and a lot of people bought earlier than they otherwise could have, and that was a rational decision. So we already had a wave of people coming in. So if we're looking at that was prices hitting the roof, and that demand, a lot of that demand was pulled forward. We still have a lot of demand out there, but that monstrous, spectacular wave of demand is not coming back. And a lot of the people that are willing demand are not able to demand. They've been priced out of the market, and especially if prices were to go up more. I just don't see a big spike in prices. Could we fall back into a 4, 5, 6% annual appreciation rate? We could see that if rates drop to 4, 4.5, 5%.
I mean,
I hope not too. The affordability sucks. People need, you and I believe strongly that everyone should own a home. We believe in the power of home ownership, the benefits of home ownership. So we would like to have that possibility for as many people as possible. And we don't have that right now with where affordability sits.
Yeah, and I mentioned it earlier in the show, and I don't think rates coming down sends prices higher. Not at this rate. Not with where I think rates are going to go. Now there is a rate where I think prices could go higher, but I don't think we're seeing those rates anytime soon. So I think rates in the low sixes, high fives. Yes, it helps stir up some buyer demand, get some people off the fence. Yes, some areas probably see some appreciation. I think for the majority of most areas you see just continued what we've been seeing, just more of the same. Question for you, Josh from Jonathan. If I use a primary loan for a new home, can I refinance my previous home into a primary loan if I move back after 3 years?
In general, the answer is yes. You're going to have to reestablish that as your home. They're going to make us show, hey, we didn't put it on last year's tax return as a rental. Who are the utility bills in? Where does the tax bill go? Where do you file your tax returns? It's reasonable that they're going to ask questions. And let's say if you go and buy a $2 million beachfront house and you say, I'm moving back into my $300,000 inland condo, that's going to be a little bit more difficult versus if we have two $500,000 single family residences on opposite sides of town, or in two towns, an hour away. Much easier. If you have one that is just vastly superior to the other. I have a buyer here, Jeb, the Chesters, they previous Californians, they're back in Tennessee. They're selling, they're not selling, they're keeping a $1.2 million, 6,000 square foot, 6-acre estate in Tennessee. And they are downsizing into a very, very nice $800,000 house in Tennessee. And the underwriter asked in that situation, why? And that's all we had to do is just explain why. Very good explanation. This house has 2 ground floor master suites. They care for one of their family members. They needed that. They didn't need the giant house. They needed less maintenance, less upkeep, a nice house that made more sense. So a lot of that is it common sense? Can we paint a story for the underwriter that makes sense as to why you're doing this?
All right. Platinum Black says, do buyers still write letters to owners trying to convince them to accept their offer? Another thing GPT might be helpful with. Yes. I mean, in fact, I had on a property that I listed last week, we ended up with 3 offers. 2 of the offers wrote letters to the seller. Basically just, same thing, a buyer letter. Now sellers have an option in the listing agreement to check whether or not they want to receive those letters. In my experience, most sellers want to see them. They want to see who's buying the house. Whatever. So we send them over. In some scenarios, we don't. But if somebody wants to see them, part of it is like we're required to send it. Now, what I will say is some agents don't even ask their clients, and they just say, "Hey, basically, we don't want to see those. Don't send them over." So just talk to your agent. I don't think there's anything wrong with a buyer letter when it's done right, but to each his own. So
I think what he was asking is, he says, I think GPT might be helpful with this. He could say, I'm just a boring single man. No one cares about me. So GPT, write the greatest love letter to a seller as to why me and my family and my 7 adopted children want to make this our home.
Well, you just, does he have 7 adopted children?
No. I'm saying we're going to turn
and boring.
We're going to turn.
You just said a lot of things about.
We're going to take GPT and use GPT to take him from a boring, unattractive love letter to the most amazing one ever written.
Sorry, Platinum. You just got Josh is really making a lot of assumptions about.
He says exactly. He says exactly. He says exactly. That is exactly what he's thinking of.
Just attacking you.
Creative writing through GPT. I like this. I like this idea. You could have it make images of your family too.
There you go. Have one of each demographic, just like a family, like your 10 different.
These are my adopted children. I've got one from every continent, every sex, everything.
Yeah, there you go. Sarah says, thank you. Great content. Oh, she didn't even say thank you. She just said great. Oh, she did. But she started with great content. And then
you got dyslexic.
So we appreciate the comment there. Means a lot. We answered Jonathan's question there a moment ago. And then we've got, who do we have here? Josh. Illust the dancer.
It's elite. Elite. Maybe it's not. He's not just elite. He's ill and elite.
Maybe I like illest. I like saying I'm the illest dancer. Illest the dancer.
Okay.
Kind of like Just that's what I do, Josh. I
Was
just
that your,
make up
was that
stuff
your claim to fame in Kinston at Kinston High?
when I can't read that. I just make up words. There we go. Got a FaceTime video.
Whoa.
A FaceTime. Here's the best part. This is a FaceTime video from somebody I don't actually even know.
That's awesome.
Like, should I pick it up on camera here and be like,
it could be nudity.
like,
It could
this
be
is
things
really
you don't-
weird,
It could be things you don't want to see. You
Yeah,
could
we
get
don't
us
wanna do that.
demonetized.
Yeah, that. Let's not do that. All right. I want to buy a fourplex, but the math has me editing costs quite a bit. Have you seen eating costs quite a bit? Have you seen anyone recently make any money on these properties? The prices just don't make sense to me. Love the show. So appreciate that. Understand, guys, I say this all the time. My screen, like the font is like a 0.1 on this thing, the way I have to read it. So I apologize there. Fourplexes, there depends on where you are. I know there are areas of the country where they can still make sense to buy a fourplex. Rents are close to covering or even cover in some cases, depending on the down payment. Places like Southern California, California in general, New York, some of it's very difficult to make the numbers make sense without a huge down payment. And to be completely honest, I think there's probably better places you could put your money in this environment with that large of a down payment and get a better return than you can on a fourplex. But there's something about owning property and the long-term benefits that I can get behind and understand. I just don't at the moment see a lot of property. I haven't seen anything that's caught my eye that's like, hey, that looks like a smoking deal, or something I would even consider.
Yeah, 100%. I get this one all of the time. And the answer is, if it's a pure investment and you're starting out as I'm just investing, if you're looking at high cost areas, it is not going to make sense. You're going to look at a massive down payment and probably a slight negative to a tiny positive. The numbers are very, very difficult right now in the current market, unless you have a big down payment. Many of those transactions are literally just people exchanging from one property into one a new one they prefer more.
All right. Good stuff. Smart Fox, do you think it's worth waiting a couple of years to buy? I can lose my property tax here in California looking for a deal I want. It's one of those things.
If I wait. You want me to just read them from now on?
Yeah,
he's looking for a deal. So should I wait a couple of years? So we just answered this question from the other side. Hey, if rates drop, I think prices are going to the moon. I don't think so. I think they're going to go sideways. There's not a magical deal that's going to pop up. And especially, you didn't say you're in Southern California, but nearly all of California is built out. Limited supply, high demand. I don't necessarily see it coming. Although Zillow Jeb threw their numbers out this week, the Bay Area is going to be down 8% this year. So maybe we're wrong.
Maybe. I mean, here's the thing. I don't see a rush to go out and buy, but I've been doing this long enough to where I've seen people like, hey, I'm just going to wait. And every single year, I'm surprised that home prices, not surprised, but surprised that things continue to go up in value. And, there's still people sitting on the sidelines. So I can see a world where home prices stay flat. I can also see a world where home prices do continue to go up, and we're all going, how can this continue? Especially in California where, land is hard to come by. People are, here for reasons other than just the real estate, the weather, just everything that California has to offer. So hard to say. I don't know. I don't think you're going to get a deal by way. Could be wrong. Right.
Jeb, let's circle back to this question because Platinum Black followed up with, do those letters actually sway decisions? And I will throw this in. Longtime client, one of the very first customers that came from this live show way back in 2020, 2021, Freddie and his fiance are looking to buy a home in Southern California, down San Diego area. And I didn't even know that they were engaged. I knew that it was coming at some point, but I got to see the cover letter when the offer went over. Beautiful engagement photo, wonderful story that we want to start a family. We have a home. We need something bigger. We're going to start a family. We're getting married. Whole thing comes together. They got the offer accepted, and then the seller reneged on the whole thing the next day. So it worked. Got them into escrow, and then the next day they just pulled the rug out from under them. But from your perspective, Jeb, does it work? Does it help?
I think it helps. I mean, here's the thing: it is like a lot of people have raised families in properties. They've grown up in properties. There's some meaningful tie to a property. And if you as a buyer can somehow relate to that emotion in that letter some way, that has ties. That has legs. That will work. Now, does it always work? No, because you still got to be competitive in your offer. You still have to make a strong offer. You still have to stand out in all the other ways. You can't write a shitty offer and write a great cover letter and be like, hey, I hope you choose me. It's like all of the things have to be checked. And when all things being equal, hey, this sounds like a nice family. These sound like reasonable, fair people based on this. That's where it makes a decision. I mean, the difference, in my opinion. But it can't hurt you. How's that? Like, do buyer letters hurt? I don't think so. Because you're typically writing the strengths of yourself or the strengths of the house. You're not being demeaning or, putting anybody down in those letters. So it can only help.
Well, Jeb, here's an example. Had a purchase contract come over today. I thought this was mind-boggling. They told me the property also in San Diego, in Vista, California. It came over. It's a planned unit development, so townhouse style attached on one side. It comes over. It's like $450,000. Like, what do you think about this? I'm like, I think that's a great price. So they put in the offer and multiple offers. Bam, bam, bam. Prices up, and they quickly got one at 500. So buyers went in at 450. 475 comes in, but 500 comes in. So the reason I'm saying this is they met the sellers when they went and toured the property. The sellers liked them. The sellers liked that they wanted to raise a family there, that they were just getting started. Sure. They kind of saw themselves in those people. So long story short, they had someone who wanted to buy it for an investment, keep it as a rental, that was offering $525,000. They said, hey, if you're truly capped 503 is all you can do, look me in the eyes, say 503 is the max you're comfortable with the monthly payment. And we get a contract this morning at 503, and they had an offer at 527 or 525, something like that. So it's not common. It's not common, but buyers or sellers do that, right? They're like, hey,
I will say, like, meeting the seller, having that conversation does have a much bigger impact than a letter, because there's the ability to know who you are versus just reading about it on paper. And what I will say is that, it's hard sometimes to meet the sellers, but if you're driving by, there's a for sale sign and it's something you like, stop and talk to them. Like, that's the stuff that makes the difference.
So Jeb, you're going to like this. Elite the Dancer is back. Thanks for answering. I'm also a veteran in Colorado Springs using a VA loan. Does that change circumstances? It is pronounced Elite. I made the name when I was 14, and I was in fact the illest. So you were right, Jeff.
There you go.
He was in fact the illest. So I appreciate that.
That's fantastic. That's probably the best comment of the night.
So does the VA change anything? No, it's probably the best financing that you would be able to get. I love the VA loan. We help a ton of veterans. If you want to get the illest loan, use the link below and we can help you out with that. But I don't know that it really changes anything other than you're going to get better terms. The fact that you don't have to have mortgage insurance with it. If you have a service-related disability, there's no upfront mortgage insurance premium. So from that perspective, kind of the part where it's hurting you, saying, hey, I'm having to feed this or I'm not getting it. You're going to, as a VA loan, you have to own or occupy one of those units. So you only have the rents from the other three to help you offset. And so for the most part, it's not going to be, hey, I get to live rent free because I'm renting the other three out. Colorado is going to be a little bit more affordable than California, but not a lot. Rents are probably also not going to be quite as high as in a high cost area. But if you want to go through the numbers, you use the link below. We would love to go through it with you. VA loan is great, and it would definitely help mitigate some of the things that you're seeing there, but it doesn't make them go away.
All right, here is a comment from Rob. We're at the end of the show here, but I think it's a good comment, and it touches on something I actually want to talk about. It says, Jeb knows home values are going to likely trend sideways and probably slightly dip a smidge. Home values, possibly. Geez, I do. Just read them all. Home values are likely not to go up when rates drop either, especially with capital gains. So I don't necessarily disagree with that. I don't know about dropping. I mean, dip. Yeah, I could dip. I mean, again, I think there's a possibility for a home to sell less than another comp in a neighborhood. I mean, I just did it on one of my listings. We're going to sell below what a comparable property did, and it is what it is. I mean, but my clients are still getting a good, fair value for the property. Is it going to impact the next seller? Probably not, because there are comps that support it. But here's the capital gains thing. I know there's a lot of talk at the moment about capital gains, potentially going away, people signing bills. Obviously, this has to pass and all of that. I think that is a helpful thing for sellers that have owned property a long period of time and have a lot of money tied up into it, and could definitely unleash some inventory that people are holding on to, putting in trust, trying to pass to their kids, that just don't want to upset the apple cart with that piece. If that happens, I do believe there's a possibility that capital gains exemption or going away could actually bring values down more so than anything that we've discussed recently. And because I think it could unlock a lot of inventory. Don't know for sure, but I think there's a possibility.
I don't know that there's enough to actually impact the market. There's definitely a bunch. I know I talked to a lot of people that if they could get their gains tax free, they would sell, move somewhere else, downsize, do something different. And really, Jeb, again, this is a coastal heavy price area issue. If you're in Iowa, it is unlikely
sure.
that you and your
You're not
wife
gonna
have
have a
more than
difference.
500,000 of gains.
Absolutely.
But here locally, I mean, my property is up 1.1, 1.2 since we bought it. It's definitely a concern when you go, we've done improvements so we could offset a lot of that, but it's definitely going to be more than 500,000 of gains if we were to sell. And it does make you stay somewhere longer than you otherwise would. So we have things that are really good things. Prop 13 here in California limits your taxes. We've got the smart fox not wanting to move because they have to protect their taxes. I'm in the same boat. My property taxes should be 2.5 times what they are. So if I go buy a similar house before I turn 55 in 5 minutes, then I'm going to get whacked on that end. We're going to get whacked on taxes. So it certainly opens up a lot of movement, but I think it is fairly limited geographically. And I even think in terms of the potential size of the move relative to the market is not going to make a huge difference. But there would absolutely, you're not wrong, 100%, it would impact the market in one way or another.
Well, there you go. We appreciate you being here. If Josh and I can assist you in any way, there's a link scroll in the bottom. Go through the pre-approval process to get a second quote, or if you need to get referred to a real estate agent that's vetted, that works like I do, that link will help. jebsmith.net/start. If you haven't done so already, hit the like, hit the subscribe, regardless of where you're watching from.
On both channels.
Yeah, on both channels. And we'll see you next week. Adios.
Amigos.